Okay, objection number two, you handled that one way too easily. Objection number two is, okay, well, I've heard that commercial real estate is having a really tough time. I heard there was that building in San Francisco that went from like $1 trillion to 30 cents on the dollar. So what about commercial real estate? I mean, clearly interest rates are hurting commercial real estate, right, Bob?
Well, commercial real estate was hurting well before we had a rise in interest rates, and of course, because workforce patterns have shifted, it has created particular pain in shiny office buildings in large metropolitan centers. Um, the first thing I'd say about that is um, there has been actually a fair amount of evolution on that dimension, really, even over the course of the last couple of years. Like New York City is now at an 80% midtown occupancy rate, where it was, in the 60s and the 50s before. So occupancy is coming back. It's probably not going to reach, anywhere near the levels that we saw in 2019, but it's not nearly as disastrous as some people had suggested. So that's helpful for those buildings and the yielding of them. It is true that the rise in interest rates has made the financing of those buildings more expensive, and that much of that lending has come from banks. I think the important thing to recognize, though, is that the loans you have to roll up your sleeves. It's you can't just say, well, prices are down a fair amount, therefore it's going to be a problem. You have to roll up your sleeves and understand the loans. Most of the loans are 50 LTV loans, meaning there's $50 of equity and $50 of borrowing that goes to the banks. Most of that bank lending is on balance sheet, which means that banks only have to recognize those problems at the time in which the debt comes due. On average, those debts run between 5 and 10 years in terms of duration. And they can be rolled, extended, modified. I always like to joke, one thing bankers are really good at is figuring out how to deal with bad loans. Not so much lending, but figuring out how to deal with the bad lending that they've done in the past. And, there's a fair amount of regulatory relief in place for those banks to extend and pretend. And that is not, and that is totally normal. That's how banking has worked for thousands of years, has been, take in income today, extend and pretend bad loans, and hope for the future, and eventually over long periods of time, write it off. And so you put those things together, it's a problem concentrated in a very small segment of the commercial real estate market. I should also mention, downtown shiny office buildings are only like 5 or 10% of the overall commercial real estate market. There's lots of other things in commercial real estate, like warehouses and gas stations and strip malls and multifamily apartment buildings. There's all sorts of stuff in commercial real estate. So that is not downtown shiny office buildings. Occupancy is rising. The loans are relatively well capitalized. The banks are they're taking a long time in duration, and the banks have a lot of flexibility to extend and pretend. Honestly, before the losses peak in this, like it's probably gonna be 5 years, 5 to 7 years before losses in CRE peak. And like 5 to 7 years, I mean, I don't know what you're doing in 5 to 7 years, but like we will have forgotten this conversation in 5 to 7 years.
Bob, I will never forget a conversation with you
Ah.
as long as I live. That was an easy softball. Okay, let's take the final objection, which is, all right, yeah, I hear all this stuff and extend and pretend. But what about me as an individual investor? I hear from the financial media, well, the treasury is a risk-free return, which you can obviously disagree with that. But okay, at 5% or 5.5%, I can get a CD from my bank, or I can buy a T-bill and chill, as they say, and I can just get 5%. So, shouldn't that mean that on the margin, when someone's saying, I got $1 million, I can either get a guaranteed 5%, zero risk, as they say, or I could go into the stock market, which is very risky, and the stocks are all bubbles, and we're in a bubble economy, and all these stocks are going to tank, and it's going to be like the next Great Depression. So, aren't people taking their money instead of the stock market and putting it into CDs and treasury bonds and bills? And so, can't that hurt the stock market just because there's 5% interest rates?
Yeah, well, certainly the repricing, it's normal in a tightening cycle to have a repricing of cash rates, which are risk-free essentially, relative to asset yields. And that in many ways is exactly what the central bank in any tightening cycle is trying to do, change that trade-off between holding cash and buying assets, or holding cash and engaging in economic activity. And so It's certainly true that on the margin, that has created, the higher rates on the short end have created a demand for cash relative to assets, and by almost by definition has created uh, somewhat of a drag on asset prices relative to what would have happened otherwise. That said, it's not like what would have happened otherwise was constant. That's evolved too. And in part, a big part of the story is the fact that we have had a meaningful rise in nominal incomes that we talked about fueling this economic expansion, has also been supportive to asset prices, both in terms of the valuations of the asset prices, seeing, higher nominal earnings as a function of that, but also in terms of continuing a flow of capital to those asset prices. Because if people are employed and they're earning good wages, they're saving in their 401ks, and that is supporting asset prices. That's a very stable, sticky support to asset prices. And so in many ways, what's happened when you look at what's happened, for instance, in the equity market, over the last couple of years, is that discount rates, interest rates have risen, cash rates have risen, but stocks are still up in aggregate, and that reflects the fact that those earnings have risen during that period because nominal growth has been pretty good. And then further, to some extent, that is then being further extrapolated in the future. Now, that might be a good idea or that might be a bad idea. I think it's probably a little frothy in terms of how much it's extrapolated. But the basic fundamental idea of equities rising in this environment, and I say over the last couple of years, there's a lot of fundamental oriented drivers for why equities have risen in the post-COVID period.